welcome back to Replace Your Paycheck. We've had a few questions come in from some individuals, and one of them is, what should we do about the market now? It is a little bit volatile, and with all the news and all of that, is a little upsetting. Our approach to this is pretty simple. You want to know what your downside is. So when you build a portfolio, you want to know the possibilities of how low this could go. So once you have picked your downside in your investment portfolio, the rest is easy. Because you know no matter what the market does, if it goes up really high or goes down really low, you know what your downside is, the approximate downside is. And the good news about that means you can still sleep at night. So everyone needs to know the downside of their portfolio. And if you know that, the rest of it's easy. Then you don't have to check into it every couple of minutes. What you want to do is to keep investing. Just keep that channel going. I remember in 2008, the big crash, at least for some people. I've been through lots of them, but in 2008 was a biggie. Portfolio, I think the Dow went down 40 to 50%. This is when I started this modern portfolio theory, and I remember walking into an investment conference, and Mark Mattson was there, who's the chairman CEO of Mattson Money. He's one of the money managers we work with, and I'm in the front row, and he walks into the auditorium, and the market, this is in June of 2008, so the market is headed down pretty fiercely. And he comes out and he looks at all of us and he looks at me and he starts to laugh. We must have looked just pathetic. We're all just going, oh my God. And he laughed and said, so how you doing? And that made me feel good. It was just, and he just said, hey, you should know the downside of your portfolio. If it's invested properly, diversified around the world, and you're rebalancing, which the modern portfolio is all about, you'll be fine. This is what the market's supposed to do. On average, the market goes down 20%, 3 times every 3 years. It goes down 40%, once every 10 years or more. I mean, there's a track record for all this. The good news is that the market has always come back. And this is what Mark was saying. He just laughed and said, hey, don't worry about it. If you're invested properly and you're rebalancing, you do well. So come to find out, he was correct. Part of the argument with all of this, if you are invested correctly around the 22 to 24 different asset classes, that never in the history of the market have all of those investment classes gone down at the same time. So while some are going down, some are going up. 2008, the bond side of our portfolio had gone up 8%. The other 75%, it was 75% stock, 25% bonds. The stock side had gone down to the 30, 40%. Well, the bond side was up 8 or 9. So what we did is we took profits from the 8 or 9 to get it back down to where it should be, and we bought into all of those asset classes that had gone down in value. So the good news is now, instead of having 100 shares at $20 a share, now we have 1,000 shares at 10. So when the market turned, our portfolio's prices just went up incredibly because rebalancing does a couple things for you beautifully, automatically. One is it sells high and it buys low automatically for you every quarter. So that takes all the emotion out of the investing process for you. So if you can do that, if you can get into that, have your portfolio rebalanced every quarter, make sure it's invested around the world, you're going to be fine. And sure enough, guess where the market was when all that happened? It was at 15,000. It dropped to, I believe, 7,500. That was an ouch. But within a few weeks, the market had recovered and gone, but within the year we had gone past the 15,000. We're up moving to 20, and now we just hit 50,000. The market is pulling back now a little bit, which it should do. We're back down, I think, around 49, 48, which is good. So what I want you to think, every time the market goes down, I want you to think of one word, and only one word, and that's opportunity. It's the opportunity to buy into the market at lower and better prices. When I got into this market in 1987, I believe the Dow Jones was like 540 points. It got to 1,000 and the noise, right, it's saying the market's too high, you got to get out. A lot of people did. That was at 540. Now we're at 50,000. Just think if everyone had stayed in and just kept investing. Think of the value of their portfolio today when we're at 50,000. So remove the emotion out of investing. Don't worry about it. Invest properly. Invest, diversify around the world. Rebalance every quarter. Make sure you know what your downside is so you don't have to panic every time there's a huge sell-off. Any questions, please email us, text us, call us. We're here to answer all of them for you. So thanks for tuning in. It's Robert Lettin with Dino. We'll talk to you next week. Thank you.